Hello guys, welcome to our channel. So guys, let's get to know each other before we start this video. With me, Nazwa Aspia Nurhadia, and my friend.
Amelia Zara. On this occasion, we will explain 1. Financial management fundamentals. Second time value of money. Third, capital budgeting techniques. Fourth, financial rations analysis. Fifth, capital asset pricing modal. Sixth, short-term financing decision. What is the primary objective of financial management, and how does it influence decision-making in a company? The primary objective of financial management is maximizing shareholder value by making optimal financial decisions regarding investment, financing, and dividend policies. Influence on decision-making. 1. Investment decisions. The company evaluates projects based on expected returns, such as net present value, NPV, and internal rate of return, IRR, to select the most profitable investments. 2. Funding decision. The company determines the best way to obtain funds, either through debt or equity, to keep costs low and maximize profits. Third, dividend policy. Decision. The company decides how much profit will be distributed to shareholders as dividends and how much will be reinvested for business development. For example, a company evaluating 2 investment projects will choose the one with the highest net present value, NPV, to ensure maximum profitability for shareholders. The concept of the time value of money and its importance in financial decision-making is: the time value of money means that money today is more valuable than the same amount in the future because it can be used to generate profit and is affected by inflation. Impact on investment and funding decisions. Investment. Companies prefer to receive money faster and choose projects with high profits. Funding. When borrowing money, the company considers the interest rate and chooses the lowest cost. Compare and contrast net present value, NPV, and internal rate of return, IRR, as capital budgeting techniques. NPV, net present value, measures profit by calculating the future value of money in present value. IRR, internal rate of return, indicates the rate of return at which NPV becomes zero. Which one is better? NPV is more reliable because calculating profits directly in monetary form. And IRR can be confusing when comparing different projects or those with irregular cash flows. Financial rations analysis. A company has current assets of $500,000, current liabilities $250,000. Calculate the current ratio and interpret the result. If the company has an inventory of $100,000, calculate the quick ratio and explain its significance. Current ratio calculation. The current ratio equals current assets divided by current liabilities, which equals $500,000 divided by $250,000, resulting in $2.0. Interpretation. A ratio of 2.0 means the company has twice the current assets compared to liabilities, indicating strong short-term liquidity. Quick ratio calculation. Quick ratio equals current assets minus inventory divided by current liabilities, which equals $500,000 minus $100,000 divided by $250,000, resulting in 1.6. Significance. A quick ratio of 1.6 shows the firm can meet short-term obligations without relying on inventory sales, ensuring financial stability. Given the following information, risk-free rate equals 4%, market return equals 10%, beta of the stock equals 1.5. Use the KAPM formula to calculate the expected return of the stock. Interpret the result. Given data, risk-free rate, RF, equals 4%, market return, RM, equals 10%, beta, V, pounds 1.5. Expected return calculation, expected return. 4%, added 1.5, 10% minus 4%, equals 4%, added 9% resulting in 13%. Interpretation. The stock is expected to return 13%, reflecting a higher return due to its risk level relative to the market.
Short-term financing decision. XYZ Limited. XYZ Ltd needs $100,000 in short-term financing to cover operational costs. The company has two options: bank loan, interest rate of 12% per annum; factoring, immediate cash at a 5% discount on total receivables, equivalent to $100,000 in receivables. Requirements: A. Calculate the cost of financing for each option. B. Based on financial considerations, which option is preferable? Justify your decision with calculations and reasoning. Let's analyze the cost of financing for each option. Option 1. Bank loan. Loan amount, $100,000. Interest rate, 12% per annum. Assuming a 1-year period, the interest cost is interest cost equals $100,000, x 12% resulting in $100, $12,000. Total repayment after 1 year, $100,000 added $12,000, resulting in $112,000. If the loan is needed for 6 months, the interest cost would be $100,000, 12% x 6 divided by 12, resulting in $95,000. Option 2. Factoring. Factoring provides immediate cash, but at a 5% discount on receivables. The company sells $100,000 worth of receivables, but only receives $100,000 times 1 minus 5%, resulting in $95,000. The cost of financing, discounted amount lost, $100,000 minus $95,000, resulting in $5,000. Comparison and decision. Bank loan cost for 1 year are $12,000. Factoring cost bars $5,000. Since factoring costs less, $5,000 versus $12,000 for a year, it is the better option financially. However, if the company only needs financing for a very short period, 3 months, the loan cost might be lower, around $3,000 for 3 months, making it a competitive option. Well, friends, we have reached the end of the video. Thank you for listening to our explanation. See you in the next video and the next material. See you later.